All right, let's get started. For those of you who joined earlier, I appreciate your patience as we get rolling here. My name is Mark Flickinger. I'm General Partner and Chief Operating Officer at BIP Capital. Our venture arm is BIP Ventures. And I'm really excited to bring this year's report to you and spend a little more time discussing the findings of this year's report. For those that are familiar, we typically look at a 5.5-year window backwards from mid-year 2024 backwards 5.5 years. We do two different things. One, we look state by state. You can see the states listed in the lower right hand. In the Southeast, we cover 9 states and really focus in on who's most active there from an angel's perspective, venture capital, and what the most popular deals are, the dollars deployed deals, et cetera. On top of that, on the front end of the report, we always look into the trends in aggregate. What's the data saying about the Southeast relative to what's happening in the US market? As you can imagine, from 2017 until now, there's been lots of ups and downs, and it's always interesting to see how the Southeast in particular fares relative to what else is going on in the venture capital and the private market in general. So I'm really excited to share with you today our 4 trends that we went through in a little bit more detail for those of you who have read the report. But let's just go to the central findings at the top. The volatility of the past 5.5 years, I just mentioned, kind of the run up through COVID, up through 21, 22, and then back down again through 23 and 24, is giving way to a sense of this sort of balance and recovery across the startup economy here in the Southeast. We're seeing capital deployment is slightly down or flat relative to 2023, certainly down from 21 and 22 in terms of just aggregate dollars deployed. But what's easy to lose sight of is that funding and check sizes are up over that pre-2020 level. So if you step back from the massive shock that we saw from 2020 through 2022, you can really see this continuing maturation in this trend upward and to the right. We're also seeing more different types of private capital vehicles are really taken up both on the investor side and the entrepreneur side. So it increases access and flexibility for both entrepreneurs and investors alike. And we're also really seeing this return to the fundamentals. We had a lot of hype and excitement over ideas and things that could change the world when money was relatively free. But really are focused back on the fundamentals of these quality business models. I like to say that business fundamentals never go out of style. Sometimes they're not necessarily A1 on a list, but I think they're coming back into that sort of A1 position where let's first make sure this is a scalable business that can be profitable. And so businesses that are focusing on those quality business models really do have a greater opportunity to raise capital in this particular environment. As I mentioned before, there are 4 key themes or trends that we really focused on for this year's report. And as you can see, it's a region that continues to find sort of balance, these wild swings, maturation, continued maturation, some competitive advantage. Things that were different in the Southeast now seem to be looked upon as competitive advantages. And we seem to have come through the trenches. Time will tell what happens once we get to the other side of the general election. We wrap out 2024, we roll into 2025. But it really does look to be an exciting road ahead, and we're really optimistic about what's to come. These 4 main themes that I'm going to go through in a little bit more detail are through the trough, this kind of have we gotten through the trenches? Are we starting to see the other side? The Southeast is ahead, and that's fantastic. We don't say that very often in terms of the venture ecosystem. Talk a little bit more about private credit. I'm sure all of you have heard of private credit. This is the golden age of private credit, and we'll talk about that a little bit more. And then really a focus on what's happening in the AI space. There's a lot been written and a lot of hype about AI. It is here to stay, and we'll focus on that a little bit in terms of what the data is saying about AI being the tool and not necessarily the tool belt. So first, let's cover on through the trough. I should pause just for a minute and say we will have time for Q&A. For anyone who has a question, feel free to click on the Q&A feature within Zoom, and we should have time to answer those at the end of today's presentation. So let's talk about through the trough. Everyone always asks us, hey, what's going to happen next year? What's going to happen next year? What do you think is going to happen next year? That's a very difficult thing to predict, as everyone knows. If we were good at predicting the markets, we probably would be in slightly different positions or jobs. But what is interesting to say is look at the data as a precursor of what's going on. It's no secret that times have been tough. I think in 2024, the first half of 2024, 30% of the venture rounds that were done were either flat or down rounds. That's the largest percentage in a 6-month window that we've seen in over a decade or just about a decade. But there is reason to be optimistic. That means that 70% of those businesses were up, right? 70% of the rounds that were up, as opposed to those 30% that were down. And I think the data starts to tell the story. You may notice if you look on the right-hand side of this graph that if you're just looking at the yellow, the highest yellow we have is in 2024. And if you just look at the orange, the highest orange we have is also in 2024. That's our median post-money valuation, right? So we don't have data on every deal, but it's interesting to see that these sort of average post-money valuations are going up in a time when historically or over the past couple of years, they've gone down or been flat. There is a tilt from an investor's perspective to invest in more mature businesses. So reason to believe a lot of these are follow-on rounds, but they're follow-on rounds that would have markups. Otherwise, that median valuation wouldn't go up. And the other thing that you can see is the average check size, right? If you look at the yellow line, that's the average check size in the US as a whole. Whereas you look at the orange line, it's the average check size of the Southeast as a whole. It's slight, particularly in the Southeast size, but you can see that we're no longer going down. We've flattened out and we've even gone up a little bit. So this sort of through the trough, there's reason to believe that all the shock that happened from 21, 22, recovery, second half of 22 and 2023, first half of 2024, we weathered the storm in the ecosystem. That's good news for both entrepreneurs and investors. We'd expect to be a little bit more swinging the pendulum back to the middle. We'll start to see more activity in terms of dollars being deployed. And then eventually from there, hopefully mergers and acquisitions will start to unlock as well. The next trend that's really interesting, and this is not something we often get to report upon, is how the Southeast is ahead. I think it's been interesting. If you read this year's report, we talk a lot about how the Southeast typically takes longer between rounds. So from first round to second round to third round. The time between these VC rounds mean by year and by region, typically the Southeast takes longer. The reason for that has often been described as just there's not enough capital. There's not enough capital in the Southeast, and therefore it takes longer for these rounds to come together. What's interesting about this US as a whole is you can see the time between rounds fluctuating based on the availability of capital. There's a lot of capital available on that yellow line. The time between rounds compresses. And then as capital gets tight, interest rates go up, it's harder to borrow money, it's harder to raise money. Then that time between rounds has extended to be longer than it's been before. If you look at the orange line, except for 2019, it's pretty much flat, right? Yes, it's come down a little bit from a Southeast perspective, but depending on whether the capital was free or not free, or rounds are easy to raise or not raise, a lot of people in the private markets, not a lot of people in the private markets, that kind of slow and steady Southeast metronome continues to be the same, the amount of time between rounds. I really think that this has a greater impact because of the way investment is done in the Southeast than it does have anything to do with available capital. In the Southeast, there's always been these sort of smaller check sizers, measured investment, a real focus on business fundamentals, as I mentioned before. And I think that sort of tried and true investment philosophy really benefits both entrepreneurs and investors alike. You dole out smaller amounts of capital to promising companies that warrant that investment. And then as those companies hit their next milestone, achieve what they said they were going to achieve, you invest in them again. And so that kind of consistency of kind of time between rounds in good times and in bad kind of shows up in the data here. Whereas in the US and as a whole, you can see for the first time, at least in this data set, that it's taking longer for between rounds to be completed in the US as a whole, mostly dominated by the innovation centers of the Silicon Valley, Boston, and New York, than you would see here in the Southeast. So interesting trend, and one that I think really gives testimony and kind of data-driven support for the investment philosophy of the Southeast. It's not trying to be the next anything. The Southeast is really defining itself as its own ecosystem in this private markets discussion. And I think the kind of up and down over the past 5.5 years really shows how that differentiation has thrown through and been very beneficial for both entrepreneurs and investors alike. Our third trend is certainly one I'm sure you've all heard about, and it's a rise of private credit. Private credit's been around. This is direct lending. So no longer are the banks allowed to loan to venture funds and venture funded businesses and growth equity. And that really has shifted into direct lending, or what's called private credit or private debt invested. there has been growth of over 400%, even just since 2023, over 150 new private credit funds have launched in the US alone. This has really broadened access both for entrepreneurs and for investors. You can see from a charts perspective, the amount of private debt that's been invested in terms of billions has really taken a major turn up and to the right, particularly just over the past couple of years. It's no secret or surprise that would happen with the failings of Silicon Valley Bank, Signature Bank, the ripple effect that had in the private credit space. Now with direct lending taking up a lot of that capital and the tight equity markets, we've seen a lot of entrepreneurs, sometimes out of necessity, but sometimes it's warranted based on the maturity that they have, really taking on more private credit on their balance sheet. And you can see how many dollars have been deployed just over the past couple of years. Now, this is not without risk. Taking credit into your business if you're an entrepreneur really puts a different type of risk onto your business. From an equity perspective, you're exchanging equity on your balance sheet just for ownership percentage. If you put credit on your business, that sits at the top of the stack. So credit seems less dilutive, and you hold on to more of your equity. And there's an appropriate place for that. But there's also the case where if a business goes south and you can't pay that credit back, then the credit shop takes over your business and you end up with zero equity. So we work closely with our businesses. We're supporters of the private credit space and think that there's certainly a part and an opportunity to it, but the business needs to be in a mature enough space to support it, right? That business needs to have enough revenue, have enough EBITDA if they are cash flow positive business to support funding or fueling the growth of their business through a credit vehicle as opposed to through taking on more equity. So there's a balance there, but it is nice to see there are options. There are more options than there have been before. People are playing in a lot of different spaces within private credit. And so if you're an investor or an entrepreneur that's tuning in today, recommend you just explore it to see if it makes sense, recognizing it's a different type of risk than taking equity. Not to say one's better than the other. It really depends on the company and the situation of your company to sort of decide which one is the appropriate one for you to use with your business. And then our last trend for today is AI. Everyone has talked about artificial intelligence for the past couple of years, particularly as the kind of underlying large language modules and the sort of technology has been built out. If you read this year's report, obviously we talk about OpenAI. OpenAI has taken, seems like many multi-billion-dollar rounds in 2024 alone. They took the largest venture round, I think ever, but certainly in recent memory in terms of the number of billions of dollars that they took on their balance sheet. Yeah, we say that if you're trying to invest in those tools, the kind of underlying technology and AI, and you're standing on the shore trying to go catch a wave that's just about to crest, that wave's already crested, you're going to miss it. There are plenty of people that are funding those businesses, but for the most part, that technology has been built. Not to say that it won't get better and better through time, and there's this whole maturation of AI in and of itself that you can read about. But I think for where we're investing, the types of companies that are out there, AI now becomes the tool. It's another tool in the toolbox. And for businesses that are launching now, they're solving today's problems, they're scaling in their own right, everyone has to have an AI plan. You need to know how AI is going to complement your business, make it more efficient, make it more effective, solve problems faster. You don't have to hire as many people. Maybe you can get to your customers faster. AI should be in every business plan of these businesses that are being scaled today. It's broadly available depending on which tool or which company's underlying technology you want to use. But everyone should have AI in the toolbox now. We no longer are thinking about AI businesses as a standalone solution to the market. And you can see that in the data, right? There's a massive run up in terms of the sort of median post valuation, but really around the capital invested, if you follow that yellow line, peaked at some point. And then now that a lot of those have been built, that number is starting to come down. Certainly there's skew with these large $5 billion rounds or anything that's multiple billion-dollar rounds. But we're starting to see this level off in terms of AI. And what we talk about in this year's report is how right now you can look at the data, you can parse it between businesses with AI and businesses that are traditional. As we go through the data sets and we go through time, there'll be no way to distinguish those two categories that I just outlined. they'll be the same. A traditional business will have AI in it. And so from a recommendation perspective, we talk about for entrepreneurs and for investors, we want to make sure that these businesses are using the tools that are available to them to make their solutions more effective and more efficient. The data is backing that up. Less dollars are being deployed. That seems to be leveling off. Median post valuations perhaps skewed based on these large rounds, but you can see that's gone up a little bit, but not gone up with more capital being deployed, gone up with the same amount of capital being deployed. And eventually we'll just go back to talking about companies and the solutions, and AI plays a major part in that solution, not necessarily a different business altogether. So it's an exciting trend, I think, for everyone that's being involved. We are using AI here in our own organization to help make our process more efficient. And it's still early days with all of that, but it's amazing how quickly you can use AI to enhance and aggregate data together to really put it in a digestible fashion for a human to make more educated decisions and more efficient and effective decisions moving forward. So those are this year's 4 trends that we went through. If you're interested in this state-by-state data, please go read the report. It's very interactive. You're able to click through each individual state, see what the most active types of investments are in each state, see who the most active investors are in each state, dollars deployed, et cetera. Really interesting. All the states are different. We talk about the Southeast in general and aggregate on this webinar, but states are recovering at different paces. They're recovering in different ways. They're finding strength in multiple different types of industries that they invest in, as opposed to only having one. But really worth your time to dig into the second half of the report on a state-by-state basis, whether you're an investor or an entrepreneur, to see what's going on in the Southeast in aggregate. All right. We appreciate everyone's time and attention. Thank you for tuning in for today's webinar on the state of startups in the Southeast 2024 report. And we look forward to seeing you again, either in person or online soon. Thanks again, everyone, and have a great rest of your Monday. Take care.